Okay, welcome. Today I want to look at the relative strengths or a relative strengths trading strategy, which is basically if one asset outperforms the other asset in the previous time period, then you're gonna position yourself risk on, basically invest in the market. Else you're going to position risk off, for example, invest in treasury bonds. In my example here, I want to use copper, have a look at copper versus gold. Actually, it's wrong. I'm going to look at crude oil versus gold. And the idea is that when crude oil is outperforming gold, this is a bullish signal. You want to be invested in the market, while as when gold outperforms crude oil, you want to be positioned in a defensive asset or in treasury bonds. So I'm going to use data from Quandl. If you don't know Quandl is a free or much of the data here available is for free. There's also paid data that I have never used myself, but you find crude oil, a continuous future contract, and you find the gold price, and you can load it directly with tidyquant into R. So that's what I'm doing here. We got the crude oil, we got gold, and gold going back to 16.8 and crude to 83. Yeah, and again for the market returns, I'm going to use the data from French, which is available on the data website from French, and you find it here, the daily 3-factor. You can download it as CSV and load it into R, which is what I'm doing here. Now for the signal, the idea is that we're using the relative performance of the previous months. So we're looking at 1 month's returns of the crude versus gold. And we stated when crude is outperforming gold, that's a bullish signal, else it's a bearish signal. So we got our signal here since 1983, and you see some months like the signal would be bearish, and then we got it again bullish signal, and we're gonna fit this to the market return. And the strategy basically is that when it's bullish, when the crude oil outperformed gold, we invest in the market, else we're staying risk-free in treasury bonds. And the strategy, we can have a nice plot, and you see that well, the strategy didn't manage to outperform the market in absolute terms, which might be a disappointing finding, because you see the market went up from the 1983 to most recently in end of 2020. Initially invested $1,000 got you 60,000 in the market, and only about 20 or 15,000 in using this strategy, this relative strength strategy. But what is impressive is that the major market crashes could have been avoided using the strategy. So you see that the market is a lot more rough and pass upwards, whereas the strategy is kind of smooth. And we're looking at this also from the stats. You see that the market in this since 1983 returned annual 13%, while the strategy returned 8%. However, the market got you an annual volatility of close to 18%, while it was only 11.4% for the relative strength strategy. And you can see also interesting pattern in using the drawdown. You see that the drawdowns are generally less, or they are less in the strategy. We see the market losing over 50% in the financial crisis following 2000 also, whilst the strategy always loses considerably less. And again, coming back to the plot and saying, well, the strategy is not outperforming in absolute terms. As long as we found in the stats that the annual volatility, and with this probably also certainly also the Sharpe ratio would be better in the strategy than in the market, what we can do is simply leverage up. So when we have the market, when we are invested in markets, say we invest, we got a leverage of 2. And you see that the strategy indeed outperforms the market in this pass. But let's put it back to 1. What are the takeaways? Well, we find that rising crude oil prices is a bullish signal, while rising gold prices is a bearish signal, which kind of makes intuitive sense. Like when crude prices go up, you expect the economy to go up, which probably also means that there's the stock market going up. While as if gold price is going up, investors tend to be positioned in more defensive assets, and the stock market going down. The second takeaway I want to mention is that, of course, this is just one very simple relative strength strategy, but there's other bullish indicators: copper, lumber, many other commodities, cyclical stocks, emerging markets, long-term yields, etc., that you can use for the bullish side. And the bearish, you can, besides gold, you could have a look at short-term treasury index, defensive stocks, healthcare, etc. And of course, there's many other ways to play it out, this strategy. You could have other rotation assets. You could say when the indicator indicates risk on, you're not in a market, but you're in leveraged ETFs, or you're invested in small caps or growth stocks. While as in defensive, you could be invested in gold or any other defensive asset. You could play with the time frame. We used monthly or a previous month's return. Of course, you could have a look at weekly or daily or quarterly, or whatever seems the best for the relative assets that you're looking at. And I guess the most important takeaway is that you have to keep according to the strategy, which can be counterintuitive, especially when in a crash the signal is telling you do you have to invest in the market or in a risk-on asset, whereas a typical investor is reluctant to do so. So that's it. Thanks for watching, and goodbye.